Hey everyone, I was thinking about the inflation numbers that came out last week and what they mean for commercial real estate. On the surface, the new lower CPI number has renewed speculation that the Fed will reduce rates this year. But personally, I don't think the cause and effect is that linear. I know that several economists are speculating that if the shelter component is removed from the CPI number, it takes inflation down to the 2% range, and it's been there for about a year. And therefore, the Fed should reduce rates or risk a recession. But I started thinking about this from the other side of the decision-making process. In other words, I put myself in the shoes of the Federal Reserve and considered the policy decision from what I imagined their perspective would be. Everyone's anxious to see rates go back down to normal, but the definition of normal depends on how old you are and how long you've been in an interest rate sensitive business like real estate. The normal 10-year Treasury rate for someone who's been in the business for 10 to 15 years is about 2.25%. Normal for people who were in the business between 2000 and 2009 was 4.5%, which is about where we are today. Normal for people in the business in the 90s was about 6.5%, and normal from about 1970 to 1990 was about 9%. On top of that, we've been in a declining interest rate environment since 1981. Basically, if you're younger than 60 years old, you've been in a declining interest rate climate your entire adult life. But now that rates have been pushing upward for a few years, people are becoming a bit anxious for rates to go back down again. But think about it from the Fed's point of view for a moment. Why should the Fed reduce rates? I understand that arguably the inflation target has been reached, or at least we're very close. But declaring victory over inflation too early can be costly. Inflation can be really tenacious, and unless it's fully stamped out, it can easily reignite. And the Fed knows this. Chairman Powell has said this many times over the last couple of years. So, on one hand, if the Fed reduces rates prematurely, inflation could reignite and the Fed would need to raise rates to battle inflation all over again. On the other hand, if the Fed holds rates too high for too long, they could spark a recession. Maybe. If you look at most of the economic metrics, the economy seems to be holding up pretty well. So far this year, the US has added about 982,000 jobs. That's a very solid average, north of 245,000 jobs per month. That puts us on track, if you annualize the first 4 months, to add nearly 3 million positions this year, which would be about the same as 2023. On top of that, the unemployment rate is just 3.9%, which is effectively full employment, and the US still has a labor shortage with 8.5 million job openings. Wages are growing by about 4%. Total savings, including money market funds, have been on the rise for 10 months, and new business applications are near a record level. At the same time, corporate profits are basically flat, but they're flat at a record high, and business investment into equipment and infrastructure is also almost flat. And both the ISM Manufacturing Index and the ISM Services Index recently came in at 49, just below the break-even reading of 50. So the services sector and the manufacturing sector are just below flat. And finally, the retail sales numbers also came in last week. Core retail sales grew by about 1% year over year on an inflation-adjusted basis. But if you look a little further back, the core retail sales number in April of this year was about the same as it was in October of 2022 on an inflation-adjusted basis. In other words, retail sales have effectively been flat on an inflation-adjusted basis for about a year and a half. So here's my point. Yes, it's possible that holding rates where they are could spark a recession. But as I pointed out in my video last week, a recession doesn't look likely right now. So, were I in the Fed's shoes? it would be hard to find a compelling reason to reduce interest rates right now. And quite frankly, the commercial real estate market is adapting to the higher interest rate climate. We've seen commercial real estate prices come down by up to 20% depending on the property type and the market, while cap rates have been adjusting upwards. The sector is definitely still in a recalibration process, but we're making headway. So as a commercial real estate investor, you may want to plan for the 10-year Treasury to remain range-bound somewhere in the mid 4% range through the remainder of this year. If the Fed does make a 25 basis point cut at some point, the Treasury could nudge a bit lower. But overall, it appears the economy is near equilibrium, and unless something happens to shift the outlook, a major geopolitical event, for example, investors should have some runway to work with. But as always, we need to watch for signs of change, which is why investors always need to keep their eyes on the horizon.